when do I use which order? A protection order is like having a safety net and a goal set at the same time. A protection order is a useful tool for traders, especially those who don't trade full-time. Use market orders when speed is crucial. Use limit orders when you have a specific price in mind. I use trigger orders to make a new entry when I have a breakout in mind. Every trader needs to understand order types to execute their trades. Though they're relatively simple, I've seen a lot of new traders mess up when starting off. In this video, I'll explain the different types of orders and how to use them in your trading. First, market order. A market order is when you tell your broker to buy or sell a stock immediately, no matter the price. It's like saying, I want it right now. The downside is that you might pay more than you planned. For example, if you want to buy Reliance shares at 3,000, but by the time your order is punched, the price has gone up to 3,010, you'll pay the higher price. Second, the limit order. A limit order lets you set the price you want to pay when buying or the price you want to get when selling. It's like waiting for a sale and only buying when the price matches your target. For example, if Tata Steel is at 120 and if you want to buy it for 115, you set a limit order. Your purchase will happen only if the price drops to 115. Patience is important with limit orders. A trigger order. Traders typically think of it like a stop loss order, but my use case for it is a bit different. I use trigger orders to make a new entry when I have a breakout in mind. Imagine Infosys shares are trading at 1,500 and you believe that if the price goes above 1,600, price will break out and rise quickly. You can set a trigger order to buy when price crosses 1,600. This means your order will be purchased when the price crosses above the set level, ensuring you get in on the upward trend. Now you must be still wondering, what about stop loss? Well, for that I use what we call a protection order. A protection order is a useful tool for traders, especially those who don't trade full-time. It allows you to set both a stop loss and a target price in one single order. Imagine if you bought some options for Nifty at a price of 50 rupees. You're worried that the price might drop, so you set a stop loss at 40. At the same time, you hope the price will go up, so you set the target price at 70. This means if the price falls to 40, your option will be sold automatically to prevent further losses. If the price rises to 70, your options will be sold off automatically to lock in your profit. This also has a one cancels the other feature to ensure when one order executes, the other is automatically cancelled. In simple terms, a protection order is like having a safety net and a goal set at the same time. It ensures your trades are handled automatically based on the prices you set, so you don't have to constantly monitor the market. Now you might be wondering, when do I use which order? Well, it depends on your trading style and goals. Use market orders when speed is crucial and you're okay with price uncertainty. Use limit orders when you have a specific price in mind and can wait. Use trigger orders to enter during a breakout. And use protection orders every time you take a position in the market. So there you have it, folks. You're now equipped with the knowledge of different order types. Use them wisely and may the market be ever in your favor. Remember to like, comment and share if you found this helpful. Until next time, happy trading.